Good afternoon, everybody. Merrill Chandler here, your guide to the Get Fundable universe. And this is our Tuesday update. Every Tuesday at this time, we kind of check in and see what's been going on in the lender marketplace, credit instruments, the things that are going on. And I got to tell you, there is evidence that there's some things loosening up out there in the marketplace. So let's do a little bit of homework or review my homework. First of all, I want to thank Sky Copier, my producer, for doing the initial research and capturing many of the data points that are going out there. Here is what we're finding. During COVID, of course, and I've talked about this for over a year and a half now, when lenders only make money when they lend. But during times of financial stress, they lend only to hyper or professional borrower levels, right? They want to make sure that individuals have proven over the past 3, 6, 12, and 24 months that they have the chutzpah, they have the capacity, the capability to continue to engage and pay back any debts. Well, interestingly enough, there was a huge, when everybody got kind of sheltered in place. I haven't used that term for a minute. When everybody shelters in place, we stopped buying cars and buying houses, and there was a constriction, or credit usage was at a constriction, and people were using the stimulus checks or the generous Social Security, unemployment checks that were kind of buffered and bumpered by the federal addition to those funds. They were using those to get out of debt. There was a massive decline in credit card debt and even some auto loan payoffs. Well, lenders, of course, are interested in borrowing only to borrowers who are lending to only to borrowers who have the capability to repay those new debts. Well, interestingly enough, according to the Federal Reserve, last month, they produced a report saying that 27% of banks eased their lending standards for credit cards. Why? Because the interest income that was coming from all of these from borrowers carrying these credit card debts, these credit card balances, they actually have declined in the payoffs. So they've eased back their approval standards and want to re-engage borrowers with more credit card debt. Now there's 17% of banks ease the requirements for auto loans. So these are two big, credit cards and auto loans are two big flagship products in the consumer borrowing space, right? So each one of those, a significant number of lenders have eased those standards. Now, as fundable borrowers, of course, we have an opportunity to leverage these new debt and credit instruments so that we can finance and fund our Z, right? And with the pandemic coming to it's kind of a stumbling close, it's time for us to reevaluate our Z's to make sure that we have a plan, not just to fund our next deal, but how are we going to build the quality of our lives and build our standard of living, right? What we want for our lives. So the total credit card debt climbed 35 billion from the month prior, after a $20 billion $20 billion gain in April. So the borrowing is increasing over a year ago, or year after year, right? 2020 to 2021. Interestingly enough, mortgages not so high as 17% and 27%, but mortgages have also eased lending, calculated by Fannie Freddie by 2.2%. So there is some significant movements in people getting out there. They're going and getting the car maybe that they put off last year. since they've paid off credit scores have risen, fundability has improved, and so folks may be looking for personal loans and or credit cards so that they can enjoy. As you guys may know, travel is up hugely this time last year, and so the opportunity to travel, family, vacations are all back in play, and many of course borrowers use credit to leverage those buy now and then pay later. The figure shows there's greater and greater confidence in the economy as it continues to strengthen. And there's a bubble I do want to mention. It's kind of different here, but one of the big updates was that in April, 4 million employees basically left their jobs. They weren't laid off, they weren't fired, and so there's more on this as it develops. But there's a lot of news outlets as well as the government oversight committees who are looking to see, well, where did they go? Where did these 4 million people go? One of the things that we know in our space is that so many of them may be turning to entrepreneurial endeavors because they were able to save up money. They continued working. Maybe there's not as much, they're not spending as much commuting, going to work, etc. And they're starting endeavors on their own, basically pulling out that entrepreneurial spirit and seeing what they can create. Gig working is healthy and well. So there are a number of things that are changing, even though we're technically post the phase one of the pandemic, right? Where vaccinations are up, everybody's working on returning to a healthy workspace, healthy environment. There are 4 million workers stopped their W2 jobs. So we'll get back to that as we learn more. So personal credit cards, personal loans according to Equifax, in April, we've also had an increase in personal loans, auto loans, and leases. Now, and those auto loans and leases, a lot of that is because people have less debt load. Their payments in their debt to income ratio, they have room for more debt. And so the acquisition of auto loans or additional credit cards is definitely in play. So if you have any questions, let's keep this dialogue going inside of the in the comments. But if you like what you're hearing, share it to folks. Maybe you know one or more of the 4 million worker W-2s that have disappeared from the marketplace. We'd love to hear your comments. Like, love, share, and make sure that the people who matter to you get the information that they deserve to know to make smart borrowing decisions. This is Merrill Chandler. Thank you for joining me, and we will see you over and over, but we'll see you next week, same bat time, same bat channel, here at 1:30 Mountain Time for the next news update. Thank you.